Hi there, I'm Lars Hansen and I'm part of the team here at Reyker. 9 out of 10 times that I flick through a financial newspaper of late, I come across an article about the latest company issuing their intention to float on a stock exchange. This must be the busiest period post-financial crisis for the UK listing authority, as they're the ones who control the listing process on the London Stock Exchange. Anyway, this jargon buster is to take a high-level overview of the contrast between private companies and public companies. It relates to the recent flow in the IPO market, because prior to a company listing on the stock exchange, where the company essentially becomes a public company, the company is classified as a private company. I guess the question is, what makes a public company a safer bet for a potential investor's point of view than investing into a private company? I know that this is a bit of a sweeping question, but for this jargon buster, let's just run with this question. Okay, I'm going to run you through 5 key characteristics. Characteristic number 1, stage in the life cycle. Private companies tend to be in the earlier stages of the business life cycle compared to their public counterparts. This generally means that a public company is more established in their market sector, which can provide some assurance to potential investors that the company is not going to just disappear. Characteristic number 2, size. This characteristic somewhat relates to what was just discussed. As private companies tend to be smaller, they can therefore be a riskier investment. Larger companies have the resources to be able to maneuver their businesses out of trouble, and therefore you know that your investment won't hopefully disappear overnight. Characteristic number 3, quality and depth of management. Public companies have greater depth of management and are generally better at attracting candidates. This is mainly because they have the ability to compensate their managers with higher pay packets, and therefore can compete for the most qualified and experienced managers in the market. Characteristic number 4, quality of financial information. Public companies are required by law to produce annual accounts, etc. There's no obligation on private companies to produce these, and therefore it's often less detailed financial information available to potential investors. Having less detailed financial information available means that it can be harder to analyse the true value of a private company. And characteristic number 5, liquidity. I left this characteristic to last, as this is probably the most important factor. Private company shares are not actively traded on any exchanges, and therefore they tend to be less liquid than public company shares. This poses a big problem for investors, as it makes them harder, or in some cases even impossible, to exit their investment. Of course, there are many advantages of investing into private companies, but potential investors do need to understand the risks involved before handing over their cold hard cash. For more information on how to go about investing into publicly traded companies, please speak to our dealers on 0207 397 2596. They will happily run you through the process. Thanks for watching.